Right now, millions of Americans are doing everything right. They're maxing out their 401k. They're stacking money into their IRA every single year. They've been told over and over that this is the safe path to retirement. But here's something almost nobody talks about until it's too late. The very account you think is protecting your future could be quietly setting you up for one of the largest tax bills of your entire life. Most people have no idea that the government isn't giving you a gift when they let you defer taxes on that retirement account. They're giving you a loan. And one day that loan comes due on their terms, not yours. If that thought makes your stomach turn a little good, it should. Because before we go further, if you care about protecting the wealth you've worked decades to build, hit that subscribe button and tap the like button right now. This channel exists for one reason: to help you see the financial traps before you fall into them, not after. Let's start with the story almost every retiree believes. You put money into a traditional IRA. You don't pay taxes on it today. Your money grows for 30, maybe 40 years. And by the time you retire, you've built a nest egg that looks beautiful on paper. $500,000. Maybe more. That sounds good on paper. Until you run the math. Because here's what nobody explains clearly enough. That number you're staring at isn't really yours. Not all of it. The government has been a silent partner in that account the entire time, and they're waiting to collect their share the moment you start pulling money out. And the worst part? You don't get to choose when. The IRS does. This is where things get dangerous. Once you hit your 70s, the government forces you to start withdrawing money from that account whether you need it or not. It's called a required minimum distribution. And if you don't take it, you get hit with a penalty so severe it would make your jaw drop. We're talking about a quarter of the amount you were supposed to withdraw, gone, just for missing the deadline. That's not a typo. That's the law. But that's only part of the story. Picture a couple, we'll call them Richard and Linda, both 68 years old, living in Texas. They did everything the financial books told them to do. They saved aggressively into their traditional IRA for 35 years. By retirement, their account sits at $750,000. They feel secure. They feel like they won the game. Then the required withdrawals begin. And those withdrawals get added on top of their Social Security income. Suddenly, they're not in the low tax bracket they expected. They're pushed into a much higher one. Every dollar they pull out gets taxed as ordinary income, the same as if they earned it from a job. And here's where the numbers get even worse. That bump in income doesn't just cost them more in federal taxes. It can increase what they pay for Medicare premiums. It can make a portion of their Social Security taxable that wouldn't have been taxable otherwise. One single retirement account is now reaching into multiple corners of their financial life and taking a bite out of each one. Over the next 15 to 20 years of forced withdrawals, Richard and Linda could end up paying well over $100,000 more in taxes than they ever imagined. That is real money. That's not some abstract number on a spreadsheet. That's the difference between leaving an inheritance for their grandchildren or watching their savings get quietly eaten away, year after year, by a tax bill they never planned for. And here's what makes this even more painful. Tax rates today are historically low. Most people don't realize that. They assume taxes will stay where they are or even go down. But the United States is carrying a debt level that has never been seen before in history. Trillions upon trillions of dollars. And that debt doesn't disappear on its own. At some point, somebody has to pay for it. History tells us exactly who that usually ends up being. Regular taxpayers, especially those with large traditional retirement accounts sitting there, fully taxable, fully exposed. This changes everything about how you should be thinking about your IRA. Now here's where it gets even more personal and even more urgent. Many retirees don't just take their required withdrawals quietly. Life happens. A roof needs replacing. A medical emergency shows up. A grandchild needs help with college. So they pull out extra money from that IRA to cover it. That single decision, pulling out an extra $20,000 or $30,000 in 1 year, can push them into a tax bracket so much higher that the actual cost of that withdrawal balloons far beyond what they expected. A withdrawal that looks like it costs them $6,000 in taxes can end up costing closer to $10,000 or $12,000 once everything is factored in. The math simply does not work the way most people assume it does. And then something happened almost nobody expected. In recent years, lawmakers have already started shifting the rules around these accounts. The age you're forced to start withdrawing has moved. The penalties have been adjusted. Inherited IRAs now have to be drained within 10 years instead of being stretched out over a lifetime, meaning your children could inherit your account and be forced to take massive taxable withdrawals during their own highest earning years, creating a tax nightmare you never intended to leave behind. That alone would be bad enough. But it gets worse. With inflation pushing the cost of everyday life higher over the past few years, many retirees are being forced to withdraw more from these accounts just to keep up with rising grocery bills, rising insurance costs, and rising healthcare expenses. Every extra dollar withdrawn to cover today's higher cost of living is another dollar pushed into taxable income, accelerating the very tax problem we're talking about. So what's the alternative? Here's where things start to shift from fear into opportunity. Some people, instead of letting their entire retirement sit in one heavily taxed traditional account, have been diversifying, moving portions into Roth accounts where future growth and withdrawals aren't taxed the same way, looking into tangible assets like gold and silver as a hedge against the very inflation and currency pressure we just talked about, spreading their financial foundation across multiple types of accounts so no single tax rule, no single government decision, can control their entire future. This isn't about panic. It's about awareness. The people who end up in financial trouble in retirement usually aren't the ones who saved too little. They're the ones who saved a lot in the wrong structure without understanding how the rules would eventually work against them. Here's the biggest lesson hiding inside all of this. A retirement account isn't safe just because it's big. It's only as safe as the tax strategy built around it. Richard and Linda didn't fail because they didn't save enough. They failed to realize that the government had a claim on their money the entire time, quietly waiting in the background, and that claim only grew larger the longer they waited to address it. If you're watching this and you have a traditional IRA or 401k, ask yourself honestly, do you know what your required withdrawals will actually look like in dollars 10 or 20 years from now? Do you know what tax bracket that could push you into? Most people don't. And that's exactly the gap this channel exists to close. I want to know your situation. Drop a comment below and tell me, are you worried about taxes eating into your retirement savings? Do you already have a Roth account? Or is everything sitting in a traditional IRA right now? Your answer might help someone else watching this who's facing the exact same fear and doesn't know where to start. If this video opened your eyes even a little, do me a favor and hit like, share it with someone you know who's getting close to retirement, and subscribe so you don't miss what's coming next. Because in the next video, we're going to break down something even more specific and even more dangerous. How one single withdrawal made at the wrong time, in the wrong amount, can end up costing you thousands of dollars you never saw coming. That video is called How One Withdrawal Can Cost You Thousands, and after watching what we just covered today, you do not want to miss it.